All right. Well, good evening, everyone. Thank you so much for joining us this evening for Secure Futures of Financial Empowerment Workshop for Widows. We're so excited to have you here tonight with us, and we're so excited to have Carolyn Howard here, Certified Financial Planner and Senior Wealth Manager, to lead us through this exciting presentation. We will have time for questions at the end. Feel free to raise your hand at the end when we get to the Q&A portion, or use the chat feature, which I'll be monitoring as well, to go ahead and post your questions in there, and we can get to those at the end of the presentation. But that being said, I want to go ahead and turn it over to Carolyn.
Well, hello, everyone. I always like to start with, how are you feeling in one word? You're on here for a specific reason, and I'd like to, you can unmute yourself at the time that you want to speak, but Lynn, you have two people with you. Are you both widowed people? Brent, can you unmute her now? We had some muting issues earlier, so just
let me try. I can ask to unmute.
Yeah, okay. All right.
Yes, thank you, Carolyn. Thank you, Brent. I am a caseworker, a job and life coach at Goodwill, and sitting next to me is my beautiful colleague, Joan, who has suffered loss recently in September. And as her caseworker, I thought this would be very, very beneficial for her to attend. And she asked that I participate, which of course I absolutely said yes. So if you want to ask Joan, but Joan, if you want to share with the group, how you're feeling?
I'm feeling okay.
Okay, all right. All right, so Carol, Kane, how are you feeling? One or two words.
I'm doing great. I hope I can learn something from this seminar. I'm not a widow, but I'd like to look toward my future. I will have some money coming in, so I'd like to know what to do with it.
Okay, well, there may be some pertinent things. And even if you haven't been widowed, I think it's always important to know what you need to know and maybe what you don't know. So I'll leave it at that, but thank you. Cindy. Can you unmute, Cindy?
Yes, I was trying to get the volume adjusted. Thank you for your help.
Okay, what is your,
I got it this time.
how are you feeling about?
Oh, just anxious since the storm is coming, another Sarah, we're just kind of anxious.
I know it's kind of late for another storm, or any storms for that matter, but, and what about you, Kevin? Thank you, Cindy. Kevin? Okay, there he is.
You got it?
Yeah, I got it.
Technical difficulties. So yeah, I'm good.
Okay.
Thank you.
So how are you and Cindy connected?
Who's that? I'm sorry.
I think it might be a coincidence that they have the same last name.
Yes, I invited Kevin.
Oh,
okay. All right, not a problem. Welcome.
He's going on Social Security this year.
Okay, so Kevin is going on Social Security this year. Okay.
I think, or at least Medicare.
Medicare, okay.
Yeah.
All right. All right. Well, some of this may be pertinent to some of you, and some of this may just be informational. But I want to start off and just let you know that after this session, I always offer complimentary meetings to any of you with questions you may have, particularly impacting you. And at the end, there will be my email address as well as my phone number. Also, the other thing I will be doing is I have developed something called a love letter and a checklist. And I will be sending that out to Brent so that he can forward it to you. And it's just really a way of documenting your own important information. And if you have lost your person, then it gives you a checklist of all the things that you may want to consider. So with that, this is really a workshop that I have presented more than once. And I offered to present it to Women's Resource Center, and Brent and I have decided that's where we're going with this. So with that, let's get started. So this session is really about one thing, peace. So we may be anxious about a storm coming, but I don't want you to be worried about the financial storm that you may be experiencing as change happens with all of us. So how do we get there? And something has gone wrong here. I'm going to back up. Peace. There was one more thing here. I don't know what's happening. You want to maximize your income and assets while minimizing your taxes. You want to prevent mistakes that will cost you time and money. You want to master your budget and secure your estate. So let me tell you a little bit about myself. Many years ago, I was a classroom teacher. Was trying to understand my own financial situation with my late husband. And he wasn't doing it. He was a very busy person with his job. So I decided to jump in the river or the ocean, it felt more like, and start learning about finance. And boy, was I glad I had learned this, because when he died, it was all on me. I had done our taxes. I had taken care of our household budget. But when he got sick and died, it impacted me obviously in ways, if you've lost a spouse, that is extremely difficult. And there's a certain level of paralysis that happens with that, even though I had this financial background and experience. So when I did, initially, I would buy the books, I'd try to read the books, I'd fall asleep, and that's when I decided to start swimming. And it felt like I'd been dropped in a foreign country, and I had to be fluent in a language I didn't understand. So that's my background. I've now been working in this field for a few decades, and I absolutely love it, and have specifically focused on people in transition, especially widowed people. So there are 3 rules of widowed finance. And if you haven't been widowed, these are still important rules to understand. Rule number 1, do not immediately notify your banks, your credit card companies, or phone and utility providers. When things are in transition, you want to leave things as they are. Rule number 2, don't let your homeowner's insurance lapse or drive your person's car. It's really, some people have cars in their individual names. I've been working with a gentleman in Florida, and all he had to do was to take the death certificate to the Registry of Motor Vehicles, and they immediately turned the ownership over to him. So it's pretty easy in Florida, for sure. Most states are like that, but you always need to call and check on the registry. But if you drive another person's car and that person has deceased, you could be potentially in trouble and liable. Take your time and don't do this alone. A good guideline is focus on income-related items first. So here we go. Step 1, deal with life insurance. If you were given the opportunity to have life insurance on your deceased person. If you don't have life insurance, this is not something that's going to pertain to you. You want to contact your person's life insurance company immediately, as the process can take time. I had a horrible experience with life insurance. So my late husband had a $500,000 term life policy through his employer that he had had for years. He had brain cancer. We knew he was going to die. So the term policy, all term policies can be converted to whole life policies without insurability when the term has expired. And we did this. So the premium was going to be very expensive, but I paid it on a monthly basis because I did not know how long he was going to survive. It felt like he was coming to the end. We did this when he was about 9 months out with his illness. When I finally got around to contacting the insurance company, which was, he died in July and it was October, I will never forget that day. It was cloudy, rainy. I lived in Boston at the time. And this girl, I'm convinced she was maybe 20, was on the phone telling me that they were going to put a 2-year hold on the death benefit because it was a new policy. She had not understood nor had read the records that this was an old policy that had been converted. So what I had to ultimately do was to get my late husband's employer involved to resolve the issue because the policy had been written as an employee of his employer. So it can be very frustrating. I'm actually working with a young widow right now, and the day before her husband was diagnosed with cancer, he had an insurance policy issued to him. He went through all of the medical, was fine, and they're putting a 2-year hold on this. She's now having to get a lawyer involved. So things can be really sticky if you just put it off. Step 2, deal with Social Security. To take it or not to take it. You're entitled as a widowed person to the higher of your person's Social Security or yours, but not both. How do you maximize Social Security income? A lot of people don't realize this, but if you're working, work as long as possible. Wait until age 70 to begin Social Security if you can afford it. So there's an 8% rule. So for every year you wait between your full retirement age and age 70, you will get an additional 8% per year in Social Security. It's simple 8%, not compounding. But I'm going to show you some numbers. So if you have never set up an account for your Social Security, go to ss.gov and set up your account. And recently they have changed that website to login.gov, but they'll direct you if you go to the ssa.gov. There it is. That changed in September. You might even want to just start at login.gov. You need a username and password. Most people use their email address as their user ID, and then create a login password. So here's an example. Let's say your full retirement age is 66 and your full retirement benefit or your person's was $2,000 a month. There is an annual, we call it the waiting bonus. So if you take $2,000, you multiply it by 8%, which is 0.08. The bonus amount is an extra $160 a month. Another example. If you wait till 67, that number becomes $2,160 a month. If you wait till 68, it becomes $2,320 a month. If you wait until 69, it becomes $2,480 a month. If you wait till 70, it actually increases up to $640 more a month. So if you're still working and you want to wait until age 70, there's a big payoff for that wait. There is zero reason to postpone it after age 70, because any of these numbers, by the way, increase with whatever the government determines inflation is going to be for that year. And for 2025, inflation is 2.5%. They usually declare it in October. The family benefit. You must have children under 18 years old. So I'm working with some families now where the children are actually getting a benefit, and you can have a family benefit. So this is important. And if you are like this young woman I'm dealing with, her daughter is not only getting a benefit, as long as the children are under age 16, she gets the same benefit as her child. Generally, that family benefit is 75% of the deceased parent's maximum benefit. And that maximum benefit is based upon their full retirement age. So you need to contact Social Security to determine the amount. And if you're not satisfied the first round of talking to someone at Social Security, ask for a supervisor. I've got some situations right now where there are two dependents under 16, and this lady that I'm working with didn't realize that she could get a benefit for them and is only getting a benefit for herself. So she's now having to go back and redo some paperwork. So don't take no for an answer. Funeral homes always alert Social Security, so there may be a clawback. So what do I mean by a clawback? This happened to me. My late husband's Social Security came into him at the very beginning of the month, July 1st. He died July 8th. So with that, I had to return that money back to Social Security. It basically was a check that I had to write and send back to them. And I was still working, I'm still working, and I wasn't full retirement age. And I didn't want to, and his Social Security was going to most likely be larger than mine. But I did not want to take a family benefit because I would forfeit a larger number. So, and this is not true. Generally, there's no state tax on Social Security, and there's no federal tax on the first 15% of your Social Security payment. However, there are about 9 states that do have a tax on Social Security. And if I can tell you what they are, it's Colorado, Connecticut, Kansas, Minnesota, Montana, New Mexico, Rhode Island, Utah, and Vermont. So they actually tax Social Security benefits. And what I find pretty interesting is some of these states are what we would call user-friendly states. In other words, they tend to be more reasonable about their constituents than some other states. But those states actually charge Social Security tax. Florida does not. Step 3, deal with a pension. Your person's employer is responsible for these defined benefits for lifetime income. So there's 2 ways, and we're going to get into this, but defined benefit is what the employer has put aside for your person. Defined contributions are what you have contributed or what your person has contributed for their benefits. So you need to speak to the employer's plan administrator to determine the value of your pension. Do not let anyone talk you into rolling that pension money out into an IRA. I'm dealing with that right now with another widowed person. She had a gentleman come to her house and he said, "Oh, you've got 2 pensions. We should roll those into an IRA. Then you've got full control of them." Well, we looked at the numbers and it makes no sense. So you've got 2 options. The bulk value of the pension is a one-time deposit. It would go into your IRA. Or an income payment, monthly or annual payments guaranteed for life. I always want to do the calculations before I advise anybody in this regard. Do not let anybody talk you into rolling it over until you've done the math. So here's an example. This is a woman that is a client of ours, and she called up one day and she said, "Carolyn, I didn't even know I had this small pension, but this is somebody I worked for years ago, and they've notified me that I have $18,000 in this little pension, and they think I should roll it over." So I said to her, "Call them back and ask what the income every year would be for you on that $18,000. Well, guess what? It was $1,800 a year. That represents 10% a year of that money. So you can see, you divide the 1,800 by 18,000, and she gets this for the rest of her life. So let me show you. So here she is, 60 years old. By age 70, she's collected her entire 18,000. By 75, she's now collected 27,000. By 80, she's collected 36,000. By 85, she's collected 45,000. I could never, ever tell you that 10% a year is something I can guarantee you. But in this particular case, this represented 10% a year on what looks like a really small pension. So she absolutely went back and said, "I want the income." At 60 years old, a woman's life expectancy is between 85 and 90. So she's going to likely win in this situation. Step 4, and if you have questions about pensions and how to calculate all that, don't hesitate to call or email me and say, "Can we just set up a meeting?" Because like I said, I'm going to provide you with complimentary meeting. Step 4, deal with your home. Figure out, first of all, if you can or you want to stay in your home. It's not just a financial decision, it's an emotional decision. Take your time. One critical item, you must get a date of death valuation or appraisal of your home within 6 months of your person's death. If you've bypassed 6 months, do not worry about it. You can always go back with an appraiser and they can give you an appraisal, but it's ideal if you could do it within 6 months. So if this is your primary residence, please get that done. I prefer using a certified appraiser and not a local realtor. Local realtors can do it, but you need to make it really clear with them this is a date of death value that you're going after, not trying to put your house on the market. Why this matters? It's taxes. Taxes drive everything. So what is cost basis? Cost basis is the purchase price of your home plus the cost of improvements. So if you've redone a bathroom, you've redone a kitchen, roof replacement is actually seen as an improvement. Not all things that we do are improvements. Replacing our air conditioning, heating, if you've got that, is not an improvement unless you really upgrade. Solar panels would be an improvement. So make sure you check to see what qualifies as improvements. But whatever you pay plus the cost of improvements, and this includes landscaping, make sure you understand what that is. Anything above that cost base is profit. So the tax you pay on any profits you make when you sell your home is what's called capital gains tax. The appraiser's valuation of your home as the date of your person's death becomes your new cost basis. And I'm going to give you an example. So let's say a rule to be aware of: each spouse can take $250,000 of profits tax-free on their primary residence without a date of death valuation and with a date of valuation. So here we go. We've got a cost basis without the date of death valuation, and you can see how much capital gains could be taxed. Here we have stepped up basis. So this includes not only your original cost basis, but the new basis based upon the date of death value. So you can see the likelihood of you paying taxes is substantially smaller. You have 2 years to sell your home and use your deceased person's capital gains exemption. So let's look at this. So let's say you paid $100,000 for your home many years ago. I would be wrong if I told you there was something likely. Well, maybe a manufactured home might be less than 100,000, but I don't even think that's true anymore in Florida. But let's say you put $100,000 in improvements. So your initial cost basis is $200,000. So now we're going to look. So your basis with no appraisal is 100. Let's say it came in and appraised at 900,000. Your person's basis was also 100,000. Remember, that total number was 200. So you have to split it in half. So you still have your basis, but now your person's basis jumps up to be half of this 900,000, or 450,000. So look at the difference in the new cost basis. With no appraisal, it's still 200. With the appraisal, it's now 550,000. So let's say it's sold for $1 million. The old cost basis that with no appraisal was 200,000. With appraisal is 550,000. The capital gains exemption in both cases, because it's sold within 2 years of death, is $500,000 in both cases. The taxable profit with no appraisal is 300,000. With appraisal, you have no tax liability, no profitable tax. So just keep in mind, with appraisal, the taxable profit is 300. With appraisal, it's 0. You multiply capital gains tax rate at 20%. With no appraisal, you would be liable for $60,000 of federal tax. And if someone lived out of the state where there was not a state tax-free amount, they would also pay state taxes. There are several states that have a state capital gains tax. So if it's not sold within 2 years of death, again, the house sold for $1 million. The original cost basis with no appraisal is 200. With appraisal, it was 550. Capital gains exemption now is only 250,000, because after 2 years, it's only your exemption that you can use. So the taxable profit here is 550,000. With appraisal, it's 200,000. So there we are. We've got taxable profit with no appraisal, with appraisal 200. Multiply that by 20% capital gains tax rate, and by not having an appraisal and selling it after 2 years, you've got a $70,000 different tax liability. If you have questions about this, don't hesitate to reach out to me. So this is why getting a date of death valuation within 6 months or longer. I've had clients, one client was 1.5 years out, but a knowledgeable appraiser can look to see what had sold within that particular neighborhood and come up with a very good number. And you want this in writing for tax purposes. So if you want the greatest tax savings, sell within 2 years. And that's exactly what I did. But a lot of people do not want to sell, and it's okay. But you still want to get that date of death valuation. Step 5, deal with other assets. Generally, our homes are one of our largest assets. But if we've worked a long time, we have other assets to deal with. We may have assets that we have inherited from our late spouse as well. There are several asset types the majority of people need to deal with. Remember, we talked about that pension income that's called a defined benefit plan that the employer has control over. Defined contribution accounts are things like our IRAs, our Roth IRAs, and 401ks. Similar to pensions, but you make the investment decisions, not the employer. And I might add, you are the one taking the risk on those investment decisions. Whereas on the defined benefit plan, the employer has to take those risks. And I will add, if a given year on a defined benefit, the plan doesn't meet the guidelines that have been established by our government, then the employer has to contribute more to match what the employees are entitled to. But that's not true with defined contributions. Market goes down, guess what? You may go down as well. So you've got 2 options on your IRAs, 401ks, etc. The first one is you could roll the assets into your name. And this is a good choice for most people. It gives you full control and you don't have to worry about it. I will say this, if it's not a spouse, you cannot do this. It has to be spouse. And that's one of the advantages of having a spousal opportunity. It's the only opportunity where we can roll retirement assets into our name. Delays required minimum distributions, RMDs. You probably have heard that word before. Right now, you don't have to take anything out until you're 73 years old. However, that doesn't mean you can't withdraw before then. It just means you don't have to. And that number is going up to 75 years of age in 2035. So about 11 years from now. It may not be a good choice of rolling assets into your own name for people under 59 and a half. And here's why. If you're under 59 and a half, there is a 10% penalty if you've rolled it into your name. All retirement assets, unless they're Roth IRAs, which aren't taxed at withdrawals, are also taxed. But you have to be careful with this. If you were widowed prior to 2020, you could still have some other options available to you. You can leave the assets in your person's name. If you're under 59 and a half, that may be an option for you to avoid the 10% penalty. It allows for immediate withdrawals without that penalty, and you don't have to wait till 59 and a half. You still will be taxed on that. Withdrawal rules can be complicated. Again, get help. I'm here to help. Then there are brokerage accounts. So what are brokerage accounts? Brokerage accounts are non-retirement investment accounts and money markets. They may contain cash, treasuries, stocks, bonds, any mutual funds we're familiar with, ETFs, which are called exchange traded funds. There's all kinds of things that can be inside brokerage accounts. If the accounts are in a trust, jointly held, or you're the designated beneficiary, they flow over to you automatically. If not, you'll need to retain legal counsel to walk you through probate. I'm going to get into probate a little bit later, but this doesn't mean you won't get it. It just has to go through the court system to get a stamp of approval. You need again to have a date of death valuation done on all brokerage accounts, just like your primary home. Example. So let's say you had the original price of your assets were $100,000. The dividends reinvested over time add to your cost basis. So now you know cost basis not only applies to our homes, but it also applies to our non-retirement assets. So let's look at an example. So your basis, remember initially the basis was 150,000. So no valuation, $75,000 for you, $75,000 for your person. Okay. Now, if we get a date of death value, the value now, that 100,000 has grown to 500,000. So now your person's basis is 250,000. That's that date of death value. You still have your 75,000. Well, something happened here. I need to go back one. Give me a second. All right. So here's the cost basis. With no valuation, it's 150,000. With the valuation, the new cost basis is 325,000. So you didn't want that asset. It was too risky. You decided to sell it. Here's the difference. The cost basis with no valuation was 150,000. With valuation, it was 325. And in this case, there's no capital gains exemption like in your primary residence. The taxable profit, 350,000. No valuation. With valuation, it's 175,000. And I just want to say one thing here. There are community property states. There's 8 of them. And when the first person dies, there is 100% stepped up value, whether it's a resident or these types of joint accounts. And though, if you're interested, those states are Arizona, California, Idaho, Louisiana, Nevada, New Mexico, Texas, Washington, and Wisconsin. So, and I've got clients in those places, and they've gotten 100% stepped up date of death value. So technically there would be no profit here. So I just want you to understand that in case you have friends, family, or you've lived there yourself. One guy said to me in one session that I did, he said, "Do you mean if I'd stayed in California, I wouldn't even have this as an issue?" I went, "Yeah." He had moved after his wife had died. So no valuation, 350,000. With valuation, the profit was 175,000. Again, capital gains rate is 20% that we've used. Federal tax bill, 70,000 with no valuation, 35,000 with valuation. Remember I said this, everything is driven by taxes. So don't lose sight of that. When we're working with clients and doing planning, we always start with taxes. And it's amazing. I have a client in North Carolina I've been working with, and her advisor told her to take money out of her IRA, but not her brokerage account. So she's paying ordinary income tax when she withdraws from the IRA, and she would be at capital gains rates if she took it out of her brokerage account. She's fixing it. So you get to specify which assets get the date of death valuation up to half of the total value. This again is it depends on the state you're in and the assets that we're talking about. Most custodians will do a date of death across the board, sort of equal, but you may get to specify which assets. Just ask about that. It can make a significant difference in how much capital gains tax you save. I had one gentleman I've been talking with recently, and he's made a lot of trades since he manages his own account since his wife died, and it's hard to backtrack what he's done to get the appropriate stepped up date of death value, so they're just gonna have to do the whole thing. Just make sure that your professional walks you through this process. If you don't have one, I can guide you. So what if you own real estate besides the brokerage accounts? Well, second homes, rental properties, commercial real estate, any kind of property like this is treated very similarly to brokerage accounts. First of all, you need to work with a qualified attorney and appraiser, again, to get a date of death valuation done. Some people have properties in, their late spouse's name, that would get a full date of death value. Some people have it in joint accounts. It varies. Unlike your primary home, there's no capital gains exemption. Work with your investment professional to decide which properties to keep or sell. I'm working with a woman right now. She's not married. She has a partner. They've been business and personal partners for years. He is in a coma and it's been very complicated, and she needs to sell some properties to be able to pay some bills. So we're working to see which makes the most sense. She's not getting a date of death stepped up value at the moment. And we hope he survives, but it's looking not good. Step 6, deal with your budget. A budget is telling your money where to go instead of wondering where it went. I love that quote. I think most of us sit around wondering, well, where did it go? Especially this time of year as we're going into the holidays. Evaluate your true income. Collect all your sources of income, your salary if you're still working, your pensions if you have one, your Social Security if you're getting it or about to get it, rental properties, annuities. We can talk a little bit more about annuities. They're insurance products that can provide income. Your investments such as IRAs, 401ks, life insurance if you've gotten life insurance, and other one-time payments. Some people are still getting, I have some clients who 2 years later are still getting money from their late husband or wife's previous job. So again, just be aware of that. So this is a very rough way to think about your budget. So if you've got X dollars coming in, you want to pay the government first. And I always say, just go at 28%. Many of us do not hit this bracket, but if you calculate 28%, then you're going to be fine. Pay yourself first with the remaining income after taxes. Save 10% of what you take home. Budget with what's left. Remember, monthly budget should be based on recurring income. Step 2, determine your current expenses. There are 3 types. You have existing versus new. So a primary residence mortgage would be an existing payment or expense. A new grad out of high school is a college tuition expense that you might have. Essential versus non-essential. A primary residence mortgage is certainly more essential than a vacation home mortgage. A lot of people in Florida have vacation homes as their second home. Where they go, they call them snowbirds. They leave the Northeast or some colder place and come to us. We have fixed versus flexible. So primary mortgage is a fixed rate, flexible are your groceries and any other things that gifts, whatever. So 3 key questions. How much is it? How does it get paid? And how do I cancel it? And this really has to do with things like the fixed ones. Home, mortgage, utilities, and landscaping is a big category. Your car payment, your fuel, your insurance is another one. Other insurances that you may have, whether it's life insurance, medical, people say, well, I'm getting ready to go on Medicare. Well, that's great, but don't lose sight of the fact that there's a cost to Medicare. There's also a cost to drug plans. And some people have long-term care insurance for those times as we age and need help with our care. Then you have life essentials, groceries, clothing, medicine. And then there are the extras, entertainment, travel, and memberships. Step 3, adjust your expenses appropriately. How do you know what appropriately means? The best budgeting secret, make decisions based on what's right for you, not the expectations of others. I can't tell you how many times I've had people come to me and tell me, my friends tell me I shouldn't be doing as much traveling as I am. My children do not think I need to be spending money on things that I like. Like I really want to get my nails done every other week, and they don't think I need to do that anymore. Don't make those decisions based on what other people think. Base it on what's right for you. What makes you happy? How does my budget support my values? If going to the salon twice a month is essential for your mental health, find a way to fit it into your budget. Step 4, execute your plan faithfully. So if anyone is concerned about budgeting, I have some worksheets. We can sit down through Zoom and I can walk you through that to help you figure out a budget if that's something you would like to do with your complimentary meeting. Step 7, set up your future. You owe it to yourself and your family to build a happy, peaceful life. To do that, you need to create a plan for the future. Step 1, understand your risk tolerance and investment goals. If you've never taken a risk tolerance little quiz, let me know and I can send you one and you can figure out what your risk tolerance is. 3 key questions. What are my biggest goals? Is it income for myself or growth for grandkids? How risky can I or do I want to be? I've had a lot of clients that I had one client, her husband, got to work with him before he died. He was sick and he was a very aggressive investor. And I asked her when I was beginning to meet with them if in fact she wanted to be that aggressive. And she said, absolutely not. So he passed, we figured out some tax strategies that helped her, but she is half the risk that he was. So you have to consider your age, your goals, and the size of your estate. And you go, well, I'm not wealthy. I don't have an estate. We all have an estate. If you own anything, you have an estate. How do I want my accounts to be owned? In a trust or with designated beneficiaries? Meet with your investment professional to discuss and implement accordingly. And again, we can help you with that if that's something you want to have us review. We review, again, investment strategies and give you our thoughts on whether they're too risky based upon your goals, age, etc. Having a will does not prevent your estate from going through probate. I told you we were going to get to this part. A will, think of a will as what you wish to be done, and it can be adhered to, but it's got to go through a process called probate. Probate is typically a long and expensive and emotional process for your family. We have a client right now, a friend left her everything, and she's been in probate now for 2 years. And I will tell you, in Florida, without proper beneficiary designation or assets being in trust, you will go through probate. And if you go through the probate process in Florida, it's 5% of the assets that go through probate, plus legal fees. You need to make sure your estate is properly structured to avoid this. Your financial advisor should connect you with an estate planning attorney to discuss your specific situation. And we have a number of really good ones in Florida. even in Sarasota. Step 2, understand your tax situation and maximize your tax savings. There's something referred to as the widow tax. That's what I call it. Unless you remarry, you will revert to filing taxes as a single filer after year 1. So if your spouse died, Joan, this year, you will get to file jointly for 2024. However, come 2025, unless you have dependent children, you will have to start filing as a single filer. And tax rates are higher as single people than they are joint. If you have dependent children, you can have joint filings for 2 years. You have 2 years to sell your primary home and benefit from your person's capital gains exemption. Meet with your CPA to understand all of your tax liabilities and plan accordingly. And I believe Women's Resource Center, Brent, you can correct me on this, but I believe you have accountants that can provide resources to clients as well, correct?
We do. We have a program called Women's Money Empowerment where you can meet with a CPA and talk about a lot of financially related matters. So if you're interested, just give us a call and we'll set you up with an appointment.
Yeah. I actually volunteer on that program to talk about money with women that need help, but I'm not a CPA. So,
Yes, many of them have
we
different
want to
qualifications.
distinguish that. So, but anyway, I thought that there were resources, and there may be some estate planning attorneys that are that as well. Then you want to evaluate your insurance coverage. Aside from your home and auto, there are 2 major types of insurance you should consider. Life insurance. So you may have life insurance on your own life. If you don't, you may want it. If you want to leave something for your children, depends on your age, of course. There's long-term care insurance. It can be helpful if you want to provide for your own care as you age. Document everything for your family. And this is where I will send to Brent to send out to you all our what we call our love letter that gives you sort of the things you need to document so that you're not in a situation where people are trying to guess everything. The worst thing that can happen is that your family is left in confusion when you pass. Taking the time to document the details of your personal and financial life is one of the big and best investments you can make. Important items to include: online username and passwords. Believe me, I've worked with people that didn't have those. It's a nightmare. Contact information for key people. Financial account information. List of other assets, whether they're collectibles, rental properties, etc. The financial account information is your own personal, your retirement accounts, your brokerage accounts, etc. So now we have time for questions and answers, but before we go to that, I want to say I also do a monthly newsletter, and if you go to hopefuleverafter.com, you can sign up for it, and I break down things in very simple ways for you. So if you want to get it, there's no obligation, no cost. I try to make it enjoyable. I happen to like to cook, so I always include a recipe. If you want to get in touch with me, there is my email address and my phone number. So please feel free to reach out for sure. So now I am going to open it up to questions and answers if anyone has any. And if you don't want to speak, you can put them in chat and Brent will let me know.
Yes, indeed. And while we wait, again, feel free to unmute yourself. If you need help unmuting, throw your hand up, wave. and or write in the chat, and I will be sure in the follow-up email to everyone to share Carolyn's contact information as well as the materials that she talked about as well, so you'll receive those. But please, if you have questions, we'd love to hear them from you.